In the medium term, after we get out of this crisis, so looking 2 or 3 years down the road, we have to rebalance both economic power and political power in the global economy. We can't just go back to the way that we were doing things before. The United States is consuming too much of the world's resources and borrowing from these countries to pay for those resources. The United States has to change its model of economic development so it uses less of the world's resources, uh, less carbon, puts less carbon into the air and leads to global warming, relies more on production in the United States, social services, spends more efficiently on education and health and other social infrastructure in the United States, so that we can rebalance these global imbalances. It's not right for the poorest countries of the world to have to lend money to the richest country of the world so that it can use up so much of the world's resources. So we have to then create a situation where countries like China and India and so forth, instead of looking to the United States to sell their products and then lend the money to them so that they can buy those products, countries like China, India, other countries also need to look more towards their own areas, their own countries, and develop their own needs, not be so much dependent on this neoliberal export-led model. Now, to make this happen, those countries, all the poor countries of the world, have to have more political power. They have to have more say in the international organizations like the International Monetary Fund, the World Bank. These countries make up most of the world's population, an increasing amount of the world's economic power. So we have to make room for them in these global institutions so that we can rebalance the global economy. In recent years, the IMF, the World Bank, have tried to impose this one model on poor countries, on every country where they have any power, this neoliberal policy. And that meant financial liberalization. It meant opening up their countries to imports from abroad. It meant allowing foreign investment to come in. It meant having very austere macroeconomic policy, reduce the size of the state, try to increase the size of the private economies. And mostly this had the impact of redistributing income to the richer people in these countries and opening these countries up to more influence from the West, from the United States, from Europe, and elsewhere. So the first thing that has to happen is that the IMF, the World Bank, have to let 100 flowers bloom. They have to give more policy space for countries to choose their own paths so that if they want, they can have a more regulated economy, perhaps a socialist economy, more closed economies, if that is the best path for them to follow. And then they have to give help to countries who are pursuing a policy where they're trying to operate in the interests of their people. Now, I think the World Bank needs to also do the same thing. But perhaps there needs to be more institutions on a regional basis. So, for example, in Asia, there possibly has to be a bigger role for an Asian monetary fund so that in Asia they can have a more regional integration and develop themselves without relying so much on the international institutions. Perhaps the same in Latin America. They're trying to create the Bank of the South to create more integration within Latin America based on a different model, not a neoliberal model, but a more social economy model. And in Africa, more space perhaps for African institutions. So I think we need perhaps both, the creation of new institutions that will have new power, will be more democratically organized on perhaps a regional basis, as well as making the international institutions more open, more transparent, and less following a single line, the neoliberal approach. Something has to be done so that we do not once again have a crisis like we're experiencing now. And there were some fatal flaws in the existing financial system. One is that every actor in this system that had power had an incentive to take excessively risky bets because they wouldn't have to pay the consequences. So rich financiers made a lot of money when the economy was going up and didn't have to give the money back when it was going down. The credit rating agencies had a conflict of interest where they were paid by the banks that were issuing these risky loans and risky securities. So they told the credit rating agencies, make these loans and securities seem like they're really safer than they are. So we have to change the incentives so that when bankers make risky bets, when it's doing well, maybe they make some extra money, but when it's doing poorly, they have to give it back. The credit rating agencies should be public. They're like a public utility so that they do not have an incentive to rate bonds and securities too optimistically. That's number one. Number two, the financial assets in this economy were made deliberately very opaque, very murky, very difficult to understand. And what happened is that when these securities were sold all over the world, nobody knew what they were. Nobody knew how much risk there was. So we have to make them more transparent. The best way to do that is to make sure that all of these are sold on financial markets where they have to have a great degree of transparency. Number three, there's moral hazard in this system. When the banks go bust, the government uses taxpayer money to bail them out. We have to stop the way that is done. Maybe the government has to save the banks, but they don't have to save the bankers. The bankers must lose their jobs. They must pay when these things happen. And then over the longer term, the bankers have to pay for their own bailouts by having, say, a securities transactions tax or a Tobin tax on all transactions that will finance the bailouts. Finally, we have to have a new banking system, one that really serves the needs of industry and of people and community. And so I think now what we're seeing is that many banks are going to be nationalized. And so the government has to have a new model of banking where it restricts the risky investments that it takes, the obscure investments that it takes, and make sure that the banks operate in the social interest to lend to cooperatives, to lend to small businesses, to lend to communities. There's one final thing, and that's what we should institute the precautionary principle. There's a precautionary principle that says do no harm, that before these financial institutions can have financial innovations, they have to show that they're not excessively risky, that they will not create too much risk for the economy. So we need something like a Food and Drug Administration like we have in the United States, so that when the banks want to have an innovation, they go and say, can we do this? And the FDA will say, make sure that show us that this is not risky. They do something like this in other countries, in India, in Spain, in other countries, and we need to institute this not only in the United States, but have a global regulatory system that does this. One other thing that we did not talk about, but is very important, is we have to close down these safe havens, these tax havens, like in Luxembourg and the Grand Cayman Islands and Bermuda. We have to bring all of the institutions under one regulatory umbrella so they cannot escape these regulations. So I think if we do these things, then we won't once again have these terrible financial crises.